So the stock market just had its first big recovery day since this whole market crash mess started. The S&P 500 was down about 10% without much interruption, but then last Friday it has bounced about 2%. Still a long way to go, but the question on everybody's mind now, has the recovery started, or is this just a big head fake to suck more investors into the vortex of a larger market crash? Now, as always, guessing and relying on gut instinct predictions is a terrible way to invest long term. I like to use quantifiable metrics that take the emotions out of it and just tell me when the probability of success is the highest. Today, I'm going to show you a really great trading indicator that you can all be watching every day that's going to give you that green light to know when to get back into the market. So I'm sure most of you watching my type of content already know what the VIX index is. It's a real-time index derived from S&P 500 options that represents the market's expectations for volatility over the next 30 days. But what some of you may not know is that there's actually VIX-style indexes derived in the same way for multiple different timeframes. We can plot them all on a curve and then use the relationship between all of them to help us time the market. And we can divide it up even further to be more specific to aggressive or conservative investors. So this is an example from a calm, stable period in the market, April 2024. We can see the VIX index right there at 1365. This is the market's 30-day expectation of volatility. This point here is called the VIX 9D. This represents the market's forward 9-day expectation of volatility. Here's the VIX 3M, the 3-month volatility index. Further out than that is the VIX 6M for 6 months into the future. And then the VIX 1Y, as you probably guessed, is the 1-year volatility index. So 9 days, 30 days, 3 months, 6 months, and 1 year. Now there's also a 1 day, but I don't find that one useful. It's just too short a time frame for any meaningful signals. But I call this system the cash VIX term structure. On this day in April 2024, this is what we call contango when we get that upward sloping curve. Contango is when further out indexes are priced higher than the shorter dated ones. In calm markets, traders do need to be compensated for taking on that future unknown risk. And the more time there is, of course, the more bad things can happen in the market. So that does arrange itself in that contango configuration. But now we can look at a date when the market was crashing. This is in the early stages of the COVID pandemic, March 2nd, 2020. 2 weeks after this was the bottom, but this day was when things started to get bad. Now we can see the shape is the opposite. We've got a downward sloping curve, and this is called backwardation. Now the shorter dated indexes are higher than the longer dated ones. Again, from a trader's perspective, of course those shorter dated contracts are going to be priced higher because we're in the market crash right now. But the more time you give the market into the future, of course we are expecting volatility to eventually come back down. That's why when the market is going down, those shorter dated indexes are going to be higher than the longer dated ones. So you'll see contango when the markets are calm, and you'll see backwardation during times of elevated fear. If you use that flip point where we can see the markets moving between these two states, it can be a really powerful trading indicator to get you on the right side of the trade. As an example, our 3 tactical strategies didn't lose any money during this latest market crash because we exited to safety a couple weeks ago. Now, of course, our volatility dashboard in every daily email to VTS subscribers is where we get those signals from. I like to harvest data from many different sources to get the most robust signals. But you can see in my dashboard, there's 3 metrics there called crossovers. We've got fast, medium, and slow. Now, this is the cash VIX term structure from last Thursday. For aggressive traders that really do want to start dipping a toe back in the water as soon as you see the first sign of calm, you can be looking to the front part of the curve and what I call the VIX 9D to VIX fast crossover. Here, the VIX 9D is still higher than the VIX, meaning short-term fear is still elevated. But when the market starts to calm down, that 9-day VIX 9D will dip down below the 30-day VIX, and that threshold could be your signal to start considering some bullish positions. Now, to be clear, I'm not suggesting you just pile 100% back into the market at the first sign of calm, but that VIX 9D to VIX ratio can be your initial signal that the market might be ready to calm down. If you're a more conservative investor, you'll want to focus on what I call the VIX to VIX 3M medium crossover. Remember, any metrics that are longer term will move slower. It won't happen as fast as the front months, but when that VIX to VIX 3M medium crossover goes back into contango, again, you could use this as a preliminary signal to start getting bullish again. And then lastly, if you really want confirmation, you can look at the VIX to VIX 6M slow crossover. Now we're talking about 1-month volatility versus 6-month volatility. It's going to take a little bit more healing to get that ratio back into contango. These 3 signals are some of the best early indicators that the market is going to calm down. And you can go into even more detail beyond just that contango backwardation flip point. That's why in my daily emails, I also show the current percentile ranking of today versus the last 20 years. That additional level of ranking the strength of the signal might help you ramp up your conviction the stronger or weaker they get. Again, we don't just want to use our feelings when we're trading these very complex markets. If you want to go down the volatility rabbit hole and learn some real quantifiable metrics, then claim your free trial to VTS on my website or in the description down below, and let me help you get on the right side of these trades. This video here shows proof of one of my favorite volatility metrics working its magic and cycling in and out of short volatility positions. And this one is a breakdown of my entire portfolio and all 5 of those strategies. So if you're ready to start crushing the market, you need to check that one out next. See you next time.